Hi, this is Ron Z. Let's look at some charts. Today we're looking at the S&P 500 weekly chart. It's about an 8-year period. It starts at the crash lows in 2009 up until the present time. Now we've looked at this chart before in a couple videos about 2 years ago. The S&P was about right here. Let's look at a short clip of that, of one of those videos now. In the first video, we looked at this trend line and this break above the trend line. And what normally happens historically is that the S&P falls either to the lower trend line or the lower support line, and occasionally breaks below it. We also talked about potential resistances that my research says could be found between 2000 and 2140. You can read more about those resistances in my articles on Examiner.com. Unfortunately, you can't read about those resistances in my articles on Examiner.com. Examiner.com sold out to an entertainment company, and the entertainment company didn't do stocks. So a lot of the people that used to write for Examiner were basically fired and let go. Only the ones that did it, only a few of the ones that did the entertainment part were kept. But as you can see, that video was shot right about here in July of 2014. Now it broke above that 2000 line and we had a large drop. It came up to almost to 2140 line. It was a little bit short, and we've seen two large drops after that. Now these three drops right here were three of the largest drops in the rebound from the S&P. The S&P had from that crash low. They're both right here. Now, the other two largest were there. Now, it also fell down to the lower trend line, and the last drop almost made it to the lower support line, as it looked like it was likely to happen. Now, it broke out of it established a downtrend, and it broke out of it and broke above that 2140. So everything's good, right? Well, maybe not. There's some reasons to believe that we might be in for a deeper drop yet. We're going to look at earnings for the S&P 500. Now, this is a year-over-year change. Basically, it's full year earnings. It's the trailing 12 months of the current year subtracted the trailing 12 months of the year before, and the difference is divided by the year ago trailing 12 months earnings to give us a earnings growth. And you can see here, this is the third quarter of current quarter of third quarter. The earnings are being reported right now. They currently have a 1.46 earnings growth over last year's earnings. Now, you can see the second quarter's was under 1%, the first quarter just over 1%, and fourth quarter was just 2.5%. You can see these earnings are the earnings growth is very small. Now, the earnings growth has been under double-digit earnings growth for now. This will be the fifth straight quarter. Now, you can see before that it was fairly rare to see under a 10% growth. Beginning at the rebound in earnings in 2009, the fourth quarter of 2009, there's a short period here where we've seen 3 quarters of high single-digit earnings growth in the fourth quarter of 2012 through the second quarter of 2013. But other than that, as we look at this line again, earnings were above or in double digits or even in triple digits in the beginning of the rebound from the crash lows. Earnings increased very quickly here. They were very low, but they increased very quickly. But we've seen a steady double-digit earnings growth, pretty steady double-digit earnings growth until recently. Now, one of the reasons this happened is, we're going to look back at that chart again, one of the reasons that happened is right here, this first drop. It was the beginning of the commodities super cycle crash. That's when oil prices fell, copper prices fell, steel prices fell, just about all commodity prices fell uh, during that crash. You know, nickel, everything. So all these commodity prices nosedived, which hurt earnings in the companies that produce those commodities. Now, as they started having earnings problems, they started making cost savings cuts. They laid off people, they closed plants, they did all kinds of things that produce cost savings. Well, they also stopped purchasing as many things from other companies. Now, that hurt the earnings of the other companies, and as earnings got hurt in those companies, they started making cost cuts and trying to save money, and it hurt earnings of other companies. Now, basically, what happened is what would have affected a relatively few companies in comparison to what it did. You know, the materials and energy sectors in the S&P make up less than uh, are about 15% of all the companies. And those are the companies that are really having problems with earnings, but it spread out. It's, you know, they stopped buying mining equipment, so now all the mining equipment makers are having problems. And then it just kind of snowballed. Uh, and these earnings problems are still happening, and it looks like they're going to happen for a while yet. Now, we're going to go back and look at these earnings again on a year-over-year basis. Here we have the third quarter. This is the difference of the third quarter in 2016 compared to what they earned in the third quarter of 2015. Now, each one of these are year-over-year differences in the quarter that we're looking at. You can see earnings. There was a lot more black back here, and there's a lot more red as we move forward. And it's not just the energy companies or the materials companies. There's not an energy company or a material company in here. In fact, here's one material sector. 15 is material sectors, and here's the oil companies or the energy companies. They're sector 10. They're all marked red because they did have they were the hardest hit with earnings. We'll see in another spreadsheet, but you can see the black turning to red in a lot of companies. Now, it's widespread. It's not just energy. It's hitting every sector, even healthcare. You know, the best sector, which is probably I consider very overpriced right now. But because they've had the best earnings, people are investing in the companies with the best earnings. Well, their PE ratios are going crazily high, even after pullbacks in these companies. Their PE ratios are still very high, 50s and 40s and 30s and 20s, and a lot of these companies with their current earnings won't reach a even value PE, which I consider 15. Some people consider 15.4, 15.7, 15.9, whatever. I consider 15. It'll take 10 years at their best earnings growth, or at their current earnings growth, 10 years or more for them to reach an even value PE. Now we'll look at the S&P as a whole. What and their current earnings growth does. The current earnings growth is 1.46%. The current earnings of the current trailing 12 months earnings per share earnings, operating earnings of the constituents are there. This is the last close, which is Friday, November 5th. The total of each closing price of the 500 companies, and it gives a PE ratio of 19.72 on Friday's close, which is the lowest close in this current downturn to this point in the current downturn. Now, that PE ratio went over 21%, or it had a PE of over 21, not percent, a PE of over 21 when the S&P reached its high last August. And earnings aren't increasing fast enough to see that PE ratio come down much. Yeah, and down price, or the slide in prices has brought it down, but earnings growth is going to take a long time to, at the current rate. As you can see here, it'll take 15 years for it to drop below 16 PE of 1.46% earnings growth. Stocks, that makes stocks priced very far ahead. If you look at in 2014, when this started to go down, earnings were over 10%. We put 10% in. It's only like 2.5 years for it to drop below 16. At 3 years, it's at 14. So the small earnings growth that we're seeing right now does not push stock, or is not reason for stock prices to go higher. There's a lot of things that are happening that could see further deterioration in earnings. One thing is there's a lot of defaults, and defaults could increase. From April to May, China saw 12,000 companies disappear. Their enterprises just disappear in that 1 month time frame. Now, I did a lot of research into that, and I couldn't find the exact reason, but one of the hedge funds in China had noted that there would be a large increase in defaults during that time period, and also the Bank of China noted that their default rate, they increased their default rate at about the same percentage as the number of companies that were just disappeared in that 1 month time frame. Now, for the rest, or I haven't checked it recently, but for most of the early summer, they were seeing growth in their enterprises, but it was at a slower rate than they've seen in the past. Plus, they lost all those enterprises. Now, and we're seeing defaults in the U.S. too, and it looks like there's some companies that could have problems coming up, and that's reason to be concerned also. Now, another thing that people are looking at is stock buybacks. The S&P is seeing a huge number of buybacks. Let's look at what that's doing for stock prices or stock earnings. Now, the S&P showed, or this PDF from Dow Jones, S&P Dow Jones Indices shows that the buybacks fell 21% in the second quarter, but they were still very high. $127 billion is a lot of money, and it also shows that the 12-month expenditures are the third highest ever, only behind the first quarter of 2016 and the fourth quarter of 2017. So, you got $585 billion in buybacks. That's a lot of money. It's a lot of stock being bought back. Now let's look at the 5 highest repurchases. Okay, we have Apple. They spent $10.2 billion. General Electric $8 billion. AbbVie $3.8. Microsoft $3.7, and McDonald's $3.4 billion. Those are the 5 largest share repurchases in the second quarter. Okay, let's look at how those share repurchases panned out as stock value or stock value to shareholders. Now, Apple decreased shares according these the ones that are in yellow are actually off their earnings reports. I didn't do all of them, but some of them I took from the internet, and some of them I double checked right directly off their earnings report, so that these numbers that are in yellow are the numbers that were reported. Um, we see that Apple reduced their share count by about 85 million shares, and on the last day of the quarter, 9:30, their closing share price is 113.95. If you multiply those together, you get a share value of the reduction, and they reduced, or the share value of that reduction was $9.7 billion. Now they spent $10.2 billion. Now GE spent $8 billion, and the actual share reduction only shows up as $7 billion. Now, you notice the next two weren't in the top five. We got McDonald's here in the number 5 position, but the other two actually increased shares, and we'll look at them in a minute. You see, McDonald's spent $3.4 billion, and they have only reduced their outstanding shares by $2.8 billion worth of shares. Now, we'll look at AbbVie. We're going to have to search for them because they're not in the top. Actually, they increased their share count, so we're going to have to look for them. Excuse me, hit the wrong button there. Okay, here's AbbVie. As you can see, they increased their share count by 3.24 billion or million shares, and they increased, and that cost shareholders $208 million. They spent $3.8 billion on shares, and they increased their share count. Now, we're not going to search for Microsoft. We can just come back up. They're one of the highest increases. They increased shares by 28 million shares, and those shares had a value of $1.62 billion. Now, they repurchased $3.7 billion worth of shares and increased their shares by 28 million at cost shareholders of 1.6 billion. Now, there might be good reasons for these increases that we've seen. I didn't check into them, but it could have been they bought a company, and they used shares in that purchase. There could be good reasons for it, but the basic fact is that share repurchases are not necessarily reducing share counts. The other thing that's happening, we're going to look at how many shares have been reduced in the first, or the percentage of share reductions in the first 3 quarters here. Now, you can see here the highest share reduction. Not all these share reductions are the result of repurchases. The highest share reduction by Watson Tower, or Willis Tower, pardon me, was the result of a merger. Willis Holdings bought Towers Watson, and I believe, I don't remember for sure, but I believe the stockholders of Towers Watson got like 1.2 shares for every share that they had of Towers Watson, or in Willis, and the combined company of Willis Towers. And immediately after that purchase closed, Willis Tower did a reverse split. They gave 1 share for every 2 shares that were out. And that resulted in a reduction in shares, a 23% reduction in shares. So Willis Tower, the share reduction wasn't due to share buybacks. Now, these others, most of these shares were actually from repurchases, or just about all of them. So we're going to look at the top 20, and TE Connect is the 20th, and we're going to look at this spreadsheet again over here and look at how they did on their year-over-year changes. I got to do a data sort here. Now, these are in alphabetical order. They aren't by the highest share reductions, but they're the top 20 companies. Now you can see there were some huge share reductions there. 14%, 13%, 13%, 12%, 12%. All of these companies reduced shares by over an eighth. They bought back over an eighth of their shares, and these companies bought over a tenth of their shares back. These companies bought a substantial amount of their shares back. But we look at the year-over-year quarterly changes in these earnings, and the earnings are going down. The share repurchases aren't making earnings go up like people are being brainwashed into believing. Actually, FedEx is seeing good earnings, but in the fourth quarter of last year rather, they had 44 cents earnings, and they're projected to only see 31 cents of earnings in the fourth quarter of this year. They bought back 14% of their shares. If share repurchases were increasing earnings, we should see a 14% increase in earnings, not a decrease in earnings year over year like we're seeing there. That is the big problem right now. Share repurchases are not increasing earnings or per share earnings like they should be. And companies are spending a lot of money on it. It could be better spent on other things, reducing debt, or in some cases, these companies are actually borrowing money to buy back shares, increasing their debt, increasing a monthly cost or quarterly cost to buy these shares back. It's not good business, and a lot of these companies are doing it. They're also increasing their debt to keep up a dividend, and it doesn't make sense. If you can't afford to pay the dividend, you cut the dividend. Now, you don't increase your debt to further hurt your earnings down the line. A lot of people are expecting these earnings to rebound, and they haven't. I expected them to rebound in 2015. They didn't. They expected them to rebound this year, and they didn't. They're expecting them to rebound next year, and the things that companies are doing makes it look like it's probably not going to rebound next year either. The things that our companies are doing are hurting earnings. Spin-offs. We've seen 5 spin-offs this last week. Alcoa spun off, or Arcanic spun off Alcoa. It's kind of a weird thing that the parent company changed names and then spun off the company with the same name as they were. Yum spun off, I don't remember the name of them. Yum spun off a company. Healthcare Properties spun off Quality Care Properties. There were a couple others. Now these spin-offs, if you look at Arcanic's earnings for the first quarter, they're 24 cents. I don't know if I can find them real quick. They were 33 cents last week, uh, prior to the spinoff when they were Alcoa. Uh, uh, so Arconic, pardon me, uh, they they have 24 cents earnings expected in the first quarter. They were 33 cents last week. So the spinoff, when a company spins off a company, they split their earnings. You know, now, and a lot of companies are spinning off right now. The reason is their stock prices are high. They spin off a company, they keep 20% of the shares, in some cases more. But to be a tax exempt spinoff, they can only keep 20% of their shares, and then they take those 20% of their shares and they sell them later. Now, they say they're spinning it off to shareholders. They're not. They're spinning it off to make money off. So if they were spinning it off to shareholders, they would spin off 100% of the shares. They wouldn't keep any of the shares. Either that or the 20% that they keep, they would hand it back to shareholders. It's to make money. It's not to do anything else. Now, so what we're seeing here is really a real deterioration in earnings. Now, we're going to look at another spreadsheet here. The earnings that have been sorted in this spreadsheet to kind of give you an idea how bad, really bad earnings are. Okay, now we can see here the energy sector is doing the worst, but it's not the worst. I mean, Chipotle has the worst earnings of all the companies in the S&P. The worst reduction in earnings year over year. Now, this is sorted by this row first. Okay. Now this row here says this is taking the current quarter's earnings and adding it to last year's earnings, or increase or decrease, and then we get a number. There's an increase, so this number is a little bit less. Now we see a lot of companies that are beating last year's earnings, which were poor, are still well below the actual loss that they had during that last quarter. And there's a lot of them in there that have shown an earnings increase year over year, but still haven't made what they dropped the year before. Now we come to the bottom of that sort. There's I have earnings for 416 of the S&P constituents on this chart for the third quarter. It's not all of them that have been reported so far, but it's a good number of them. Now we can see here either no increase or a decrease. 145, there's a header row, so it's going to be one less than the line. 145 of them have either no increase or a decrease after looking at the quarter before. They lost 5 cents, they gained 5 cents, so they're zero. Basically, they've made no growth in the third quarter over the last year's earnings, because last year's earnings were at a loss to the quarter before. Now this row, we're looking at, we add this number, the current third quarter, to the last year's third quarter, to the quarter before that. Now this is a 2-year growth. You can see all of these companies have a negative 2-year growth in the third quarter. So now we're up to 162 companies of the 416 that have reported earnings. Now, a lot of these companies back here had negative earnings in the third quarter, but we'll look at the ones that are left and that had earnings below what they reported in this quarter. So now we're down to below or at zero or no increase. Now we've got 201. Now we're almost half the companies have shown negative growth in the current quarter, a year over year on the current quarter, or 2 years negative growth. Now, as we see, earnings are getting worse as we go along. So we'll look at the first quarter of the companies that are left, and we see a bunch of them are going to have earnings below the year before, or are projected to be below or even to the year before. Now we're up to 240 or 239 of the companies. Now we'll look at the second quarter earnings, or first quarter earnings. These are fourth quarter, these are first quarter earnings, and we're up to 256 of the companies. Now we'll look at the earnings, the companies that were showing multiple quarters of losses before the current quarter increase, and the companies that showed multiple quarters of losses before the before having a positive second quarter report. And then I just put some of these ones, the worst ones, in recent earnings in, and we see we're getting almost 3/4 of the companies in the S&P 500 are in these sorts here, because earnings aren't good. They're deteriorating quite rapidly, and if we look at, not all companies are doing bad. About 1/4 of the companies are having decent earnings. They're not great, but they're having decent earnings right now. I'm sorry, I messed up the spreadsheet there, but there's some that have long strings of positive growth. Others they're spotty. They've come back from a period of losses, and they're starting to come back into growth again. But if we look at what these right here are, the companies that have already reported. Now, if we keep going down, these are the companies that haven't reported. The first quarter isn't on my spreadsheet. If we go back over here, we'll look at my spreadsheet again, or the earnings. The way I keep track of who I've got earnings on in the third quarter is, once I get those earnings, I add the first quarter's earnings or projections. That's my way of tracking of who I've already got the earnings on. That way I don't have to go back and look at everybody again. You can see those that haven't reported are having earnings problems too. I mean, there's a lot of red in here that, it's not looking good. And it doesn't look like it's going to get much better for a while. And it could be a while, it could get worse. There's reason to believe it could get worse. Now, a lot of people are projecting 10 to 15% growth next year. They expected 20% growth this year. You can see the fourth quarter projections have fallen $15 in a month. This was the previous month's projections. This quarter went up $14, but and a lot of companies are beating earnings, but it's a small growth. It started out the quarter they expected a loss, or the quarter when the quarter started, earnings started, they expected a loss. So there hasn't been a small loss. It hasn't increased that much. It's less than 2%, and it'll probably finish less than 2%. So earnings aren't good. Now, one other thing we want to look at is if you've read my articles, I've developed a 90-day indicator. There was two of them that came active last summer. One on the 25th of July and one on the 25th of August. Right? Now, these are 90-day indicators. They expire after 90 trading days. So they will expire. The July's will expire on the 30th of November, and the one that came in August will expire on January 4th. Now, these indicators, you've read my articles, and you know that there's an expiration period with them. It's a 27-day period. It's 13 days before to 13 days after the indicator. And during expiration periods of these indicators, there's a high likelihood of volatile market conditions. It could be positive or it could be negative. But right now, earnings don't appear good enough for it to be a positive influence. We're also going to see these expiration periods come due right after elections, 2 days after elections. And what's kind of funny here is this one's going to end the day after inaugurations, and they overlap. The 13-day period, expiration periods after the July one will end here, and the 13-day period before the August one begins here. So they overlap. These two indicators have an overlapping expiration period, so we're going to be in a expiration period for an extended period of time. Now, there's potential for volatility there. What happened too, we're going to look at another spreadsheet, but I want you to look at something here. The high, the current high of the S&P, all-time high, was seen on July 15th, August 15th. It's seen the daily high. It's a max of this row, which is daily highs, and the max of the daily closes. All the way through the whole spreadsheet. So this is the highest close and the highest high. They both happened on the 15th of, as we can see over here, this is the 15th of August. There's your highest high, there's your highest close. Now, and we're going to see that it's 10 days before that expiration period, and it's 20 days I'm going to say 20 days after that one. Now we're going to look at this other spreadsheet. It's the market crashes. Now, this is all the market crashes during the S&P, the actual S&P, which started on March 4th of 1957. Is the birth date of the S&P. Now you can see here, this first crash, the high, the actual high, is projected to have been on August 3rd of 2000 or 1956 rather. Now, and that's You notice that August date there too. That's going to come into play later. Um, uh, the S&P reached a high of 49.13 on July 15th. So the drop was over 20% from that high when it was actually the S&P 500 too. So that was the market crash during the S&P 500. Now these yellows here show these 90-day indicators, and you'll see that in all but two of them, this one wasn't. This one was during or close to a bottom, fairly close to a bottom, so it's marked. This one was fairly close to the bottom, but it wasn't. It was months away. These are pretty close. That was 9 days. That became active 9 days after the market top. This one was very close, but not exactly. But there were no volatile moves until that 90-day indicator became active, and then there were three during that indicator's active period, and it dropped 8.77% during that time. You see this one expired 9 days prior to the top. This one became active 6 days after the bottom. This one became active 17 days prior to the bottom. And there's only two of the market crashes or near market crashes. These weren't actually market crashes because they only went down 19%, this one and this one. But there's only two of the market crashes that we don't see one of these indicators. Now, you see here it became active 10 days after the bottom. It became active 2 days after the bottom. It became active 20 days after the top. It became active 53 days after the top. It became active 18 days after the bottom. So you can see these indicators are happen very close to market tops and bottoms a lot of times. And in fact, they're seen in large drops to July 2000, I believe it was 2013, that the market bottomed on the expiration date in 2000 of one of these indicators in 2013, I believe it was, and that was a large drop. In fact, it was this drop. I should have that one on here. And this was the drop, a 19% drop within the crash. So in fact, there was a crash within a crash here. This actually, or pardon me, this wasn't a crash. This was a near crash too, in the 70s. So you can see these indicators become active often during market crashes or near the bottoms. Well, back to the other spreadsheet again, and there's a market top on the 15th, and it became active on the 25th, and then August 25th, and then July 25th. So they're on both sides of that high. Now, that high there also, if we look at, I don't have the spreadsheet open, but if we look at highs during the August, highs and lows from August to December, you see a high in August. It's 80% of those highs in August are during a market crash. And if we see a low in the November to December time frame, they're over twice as likely to be occurred during a market crash than any other low. We've seen a low in November. We've seen a high in August. you know, the market could rebound in December. You could have an end of year run. But if we see a market low in December, there's only been 6 of them since the S&P 500 became the S&P 500 in 1957. There's only been 6 of them, and all of them have been during market crashes. One of them was actually an actual bottom of a market crash. So if we see a low in December, uh, chances that the S&P is heading into a crash are very high. Those are a few of the things I'm seeing, and we're going to go back to this chart for a second. Uh, if the market were to turn lower here, and it kind of looks like we're seeing the same pattern. You know, it broke above the upper trend line, it failed in a rebound. You know, and now it's starting to turn lower, or it's kind of the way these things seem to happen. It gets up there, it rebounds, but it doesn't make it back to that trend line, and then it falls off. And if this chart went back farther, we'd see it over and over and over again, the same type of a pattern that we're seeing right now. We've seen a rebound, and it broke above that resistance that I, it looked like my research suggested that we could probably see a large drop. We've seen 3 of them, or a market crash in this resistance area. Now it broke above it. It got about 50 points above it, but it's still really close to that resistance area. I, this research was done in 2008 and 2010. This is well before we got to this range right here. So if we were to see a market crash, the same research suggests it's possible that the bottom could come at about 1565. Now it doesn't mean exactly 1565. It could, but it could be higher, it could be lower. But the research suggests it's possible that could be your support if we were to see a market crash, and there are reasons to believe that we could. We're going to look at one more thing real quick. This is the S&P PE. We're going to actually look at a couple of things here. Now you see a 23.9. Now this is as reported earnings, and we'll see this is near market high. Now, like I said, the S&P actually started in 1957. These are workup based on the S&P 500, the actual S&P 500, but the S&P didn't start until I believe 1934, and it wasn't 500 companies. The S&P 500 didn't actually become the S&P 500 until 1957. It was fewer companies. We'll look at the Shiller, which is also shows this high. There's only a few times that the S&P has made it higher than what we're at right now. So this leads you to think that we could be near a top. Now those spikes we've seen in that PE often happen afterwards. Now in 2007, the S&P had a operating earnings PE, which is what I do my spreadsheets by, not a as reported earnings PE, of about 17. But earnings fell off the table, and we had a huge spike in PE because of it. Now we'll go back and look at this real quick here. No, I think we already looked at this, didn't we? But you know, we had a 21 per a P of 21 just a few months ago, and that's operating earnings. Very high. It's without earnings being better than they are, it's going to take a long time for. I'm going to look at this spreadsheet because it's better. It goes further. That P is very high. And it's going to take a long time at the current earnings rate of 1.46 to get to a PE of 15. Now, those are the things that I'm seeing, or some of the things I'm seeing. There's other things, but this video is getting kind of long, and I think there's reason to be cautious at this time. Have a great day trading. This is Ron Z.